Hello, I'm Regina McCann-Hess, President of Forge Wealth Management, and welcome to our Women in Wealth series. Today, we're going to take a ride down our educational road and talk about dealing with your home as part of your estate. As many of you may know, your home is probably the biggest asset that you have in your estate. And as such, it presents some very delicate estate planning issues that assets like stocks or mutual funds do not. So we're going to cover a couple possible options for dealing with your home that you should discuss with your tax, your legal, and your investment professionals before doing anything about. One of the first options is to stay in your home. If you're looking for a compelling reason to stay in your home for the rest of your life, the potential impact of your estate and your beneficiaries is a good reason, provided the value of your estate is below the estate tax exemption limit, which for most of us is not going to be a problem because the federal estate tax exemption limit is 11.58 million for individuals and 23.16 million for married couples in 2020. Okay, so we have that big number out of the way. So if you live in your home for your entire life, your beneficiaries will receive the home on a stepped up basis to its current value, current fair market value. And what that means is, normally if I buy my house, say at $400,000 and I sell it for 525, my basis is that $400,000. And then if I sell it at 525, I have to pay taxes, or it could be considered a taxable gain for that $125,000. But if you receive something at death as a beneficiary, that cost basis that the person paid for at 400,000 is stepped up to a current value at their death. And in this case, we're just saying it's 525,000. So that's the new cost basis for the home. So in thinking about that, a subsequent sale of the home after you own it as a beneficiary will not generate capital gains tax on the appreciation of your home since the time you bought it. And if your estate is below the estate tax exemption rate, your estate will also be exempt from federal estate taxes. Now, keep in mind that your estate may, however, be required to pay state estate tax or inheritance tax. So those are important things to remember. Okay, so another option is to gift the home to a child. Giving your home to a child or beneficiary may seem like a sensible solution, especially if you have multiple homes or if you plan on moving out for any reason. However, gifting comes with some pretty strict laws. For example, you will have to dip into your gift tax exemptions. In addition, some circumstances, you and your spouse may have to pay a gift tax at that point. So when you make a gift of your home, your child will not get the advantage of receiving that home on that stepped up basis that we spoke about. This means that the capital gains tax will likely be higher when he or she finally does sell the home. Now, key points that I want you to remember is that, a couple things we already mentioned, but they're important. A home is the single largest asset many people will have in their estate. A home also presents some difficult estate planning issues that other assets do not. Now, you also want to keep in mind, you need to work with your tax, your legal, or your investment professionals to develop an estate planning strategy that works best for you and your heirs. Okay. Now we're going to deal with your home as part of your estate. One of the options there is to put your home in what's called a qualified personal residence trust, and it's QPRT for short. It's a mouthful. There is an option to consider for an individual with a sizable estate to do this. And when we're talking a sizable estate, we're talking several $1,000,000. So generally, a qualified personal residence trust involves the transfer of a personal residence to a trust with the grantor, which is you, retaining a qualified term interest and the right to live in the home for a specified period. Now, the IRS makes a calculation that values your right to live in your home over the period specified in the trust. So, as a rule, this value is far below the market value of the home. So, if you die before the end of that qualified term interest, the value of the residence is included in your estate. Now, if you survive to the end of the qualified term interest, the residence passes to the beneficiaries of the trust, at which time you may relocate, pay rent, or make other living arrangements. Now, because a qualified personal residence trust is a grantor trust, there are special valuation rules for estate and gift tax purposes. Your financial advisor can help you decide if this option is advisable for your specific information. Remember, this is just educational only. We're not giving you specific advice here. It is important to weigh all of your estate planning options in regard to your home. Your financial advisor, your investment professional, your accountant, or your estate planning specialist can assist you in the decision-making process. That's all we have for today. I want to thank you for joining us on our Women in Wealth series. And please follow us on Twitter, Facebook, and YouTube at Forge Wealth. And on LinkedIn, you can follow me at Regina McCann Hess. And of course, you can always go find us on our website at forgewealth.com. Thank you for joining us and have a fabulous day.